Ms. Lee, Mr. Miller.
Chairman Compton, Ranking Member Cortez Masto, and members of the committee, thank you for your time today. Today I will speak specifically about the franchise industry. The franchise business model itself is a brilliant model and one I support. However, because of little transparency and oversight, it is also an industry with far too many examples of predatory franchise companies that take advantage of prospective entrepreneurs. Most believe this large sector is heavily regulated. The FTC does regulate pre-sale disclosure through the franchise rule and requires prospective franchisees receive a franchise disclosure document. But I ask, how many of you actually knew that the FTC doesn't even collect this disclosure, much less review it? Franchise Grade looked at 1,900 franchise systems using disclosure information from a 5-year period and noted that while 169,000 units had opened, almost 139,000 units had closed, for a net gain of less than 30,000. If this high level of failure were happening in the private market, it would be bad enough. But the SBA loan guarantee programs are enabling this failure and fraud. In 2013, the GAO reported that during the previous 10 years, the SBA made guarantee payments on approximately 28% of 7A franchise loans. Amin immigrated from Egypt to Dallas and worked 2 jobs at DFW to save in search of his American dream. He purchased a Dickey's Barbecue franchise. He was given a disclosure document and a spreadsheet showing estimated startup cost. The estimates were grossly incorrect, and his startup capital was spent getting open. He opened his business in August of 2018, and he contacted me 1 month later. He was already broke and couldn't make the payment to a 7A loan. His message to me was, in a few weeks, I will find myself, my disabled wife, and my 89-year-old mother-in-law in the street with no house, no car, and no money. Here's the problem in the industry. Far too many profit from the sale of a franchise, yet far too few, if any, are held accountable for the success of the franchise purchaser. Mark Shore retired from his IT job and bought an Experamac franchise in Henderson, Nevada. The franchisor directed him to a specific loan broker that provided him with a projection spreadsheet that showed revenue of nearly $700,000 in year 1 and $995,000 in year 2. Both, if you look at today's disclosure document, are well above the numbers in that. He is now surviving by dipping monthly into his retirement to pay his SBA loan. Michael Hadaway is a Complete Nutrition franchisee in Reno. Since the franchisor has pulled all their support, wrongly sent out an email to his customers that his location has been sold, and aggressively marketed online sales, his sales have crashed. His finances are in shambles and he's heading towards default. Jamie Stevens is another Complete Nutrition franchisee with stores in North Dakota and Minnesota. He has SBA loans totaling $1.5 million and has the same issues with his franchisor. But don't worry about the franchisor. They still kept their $49,500 franchise fee. Finally, Huntington Learning Centers. The Inspector General at SBA found that 7A loans were made with inflated revenue projections. Bob Spada from Connecticut was one such franchisee. He was again directed to a specific loan consultant to work with and applied for a loan. He received a $300,000 loan on a $500,000 first-year projection. Later, he found out that actual for an average center in the first year was $249,000. As he dug for the reasons for this high projection, he discovered the devious means. To qualify for that $300,000 loan, he would need about a $75,000 profit in that first year to meet the required debt service coverage ratio. To reach that profit level and reverse engineering the numbers, you come up with $500,000 in revenue. Bob was forced into bankruptcy. Total losses of his mortgage, equity loan, and credit cards more than doubled the SBA loan. So who accounts for those losses to the economy? I appreciate the Banking Committee's consideration of ways to curb some of these abuses and have provided some corrective steps to clean up the industry. And I appreciate Ranking Member Cortez Masto for specifically on her commitment for SBA transparency lending. In summary, the franchise business model can be and should be a model for economic mobility and realizing the American dream. However, leaving the industry to police itself is not working and destroying lives for some profit. There is no reason for this, and access to SBA money should be the model of transparency for the industry, one that ensures the best underwriting procedures to those in search of the American dream. Thank you.
Thank you. Mr. Miller, I'd like to explore with you the franchisor-franchisee arrangement. Can you talk a little bit about the financial disclosure documents that are utilized? My understanding is they're notoriously complicated and imbalanced legal documents. Talk to me about how we can improve the FDDs and related contracts, prevent some of the mistreatment that you just talked about with respect to the franchise owners.
Well, in one part, the document is so huge, the disclosure document, it's 500 pages to 1,000 pages. So you got to remember a lot of what the industry advertises to for those seeking the American dream of, be your own boss, no experience necessary, proven business models. So you're often reaching out to people who aren't, having MBAs, and yet you're giving them this document that's 500 to 1,000 pages. So trying to find the nuggets of information in there are very difficult. You also have the financial performance part of that document, which is not a required piece. A franchisor can just say, we choose not to put anything in the financial disclosure, in the financial representation part. That can be left out.
And explain that, if you would, a little bit more. For somebody who wants to start a business, they're going to have to take a loan out and start a franchise as a franchisee. But wouldn't it be helpful for them to have, from the franchise owner, to receive in that FDD actual revenue, default information that would help them, as well as the SBA that is going to be giving them the loan, to see how successful this franchise company could be?
Well, there's two parts to that. So first of all, obviously, if it's a franchise business model that's supposed to be proven, there's history and data. It's not like I'm going up and opening Keith's Subs tomorrow and have no history. So there is history there. And again, this data is not required. The SBA requires you to come up with first-year projections. Well, first-year projections have to start with some kind of revenue projection. Every franchise company knows what sales are happening in each of their outlets. That's how they collect royalties. So why are we not requiring, when people are accessing government/taxpayer guaranteed money, this first-year revenue number that everybody has? And what makes it worse, the second step is, if you notice in my examples, almost every one of these people were assigned to a hand-picked specific loan broker or a consultant that the franchisor gave them. These people are giving revenue numbers outside of the disclosure document and not violating any disclosure law by doing that. I mean, I have copies of spreadsheets that people have gotten from these loan brokers. This is the information that's going on the SBA loan, and this is how they're qualifying. These loan brokers, as I said, have actually figured out how to reverse engineer. If you're taking out X amount of loan, how much profit you have to show to get that loan, and then figure out how much revenue they have to show to get that.
And the franchisee doesn't see that information because that's shared between the franchisor and the broker?
Well, the broker will probably show it to the franchisee, but a third step, I guess, in there is, and the SBA actually presented this at a conference, that franchisors, to help loans get approved, can talk to the bank, but before they do so, sign a confidentiality agreement so they don't violate any of the disclosure laws. I mean, I can't think of anything in the world where the borrower who is signing on the dotted line doesn't know every bit of data that went into that decision.
And then the financial disclosure documents, or the franchise disclosure documents, they also contain a non-disparagement clauses. Explain how that impacts the actual individual owner.
So people always talk about doing due diligence in the industry before they buy a franchise. Well, one of those parts of the due diligence is calling existing owners. Most franchise agreements have that non-disparagement clause in it. I can tell you, if I'm in one of my stores and somebody calls me and starts asking questions, and let's say I have a negative experience, am I going to really say so? I don't know who's on the other end of the line. And while that may not itself cause the termination, it's not hard to be more difficult on a franchisee. Then the second part of the due diligence would be following up with past franchise owners who have gotten out of the system. And you have two problems there. Number one, the list in the disclosure document shows their store location. Well, they're ex-franchisees. They're not at that store location anymore, so you don't have access to reach them, number one. And number two, if they've had a bad experience and been terminated, there's usually non-disclosure clauses as part of that, and therefore they can't comment or say anything.
Thank you.
Thank you, Mr. Chair. I'm interested in this conversation about the interplay between a healthy labor market and immigration, and want to just agree with Senator Cortez Masto that what I hear in Minnesota is issues around a shortage of labor, especially in agriculture and food processing and seasonal work. But Chair Cotton, you make a point, which is people say, you know, there's this question of nobody is available to do the work at that wage. So I'd like to ask Ms. Lee, what can we do to increase wages?
Thank you. There is a minimum wage bill will be taken up by the House tomorrow, so
When was
that's
the last time we raised the minimum wage?
It was 9 or 10 years ago, so this is the longest stretch we've gone without raising the minimum wage, and the minimum wage now is I think 25% below where it was in real terms in 1968. So this is an enormous erosion in a wealthy society, a society that's more productive, more technologically advanced than it was in 1968. We ought to be able to pay workers enough so that they can afford to feed their families and have a decent place to live. So that's a key piece, and I do think we need to fix our broken labor laws so that workers have a fair chance at coming together to be able to bargain for their fair share of the wealth that they create.
This is a question that I ask Minnesota businesses all the time. If you have trouble recruiting people to fill the jobs that you have you tried paying more?
Yeah, as an economist, you have to say there is no such thing as a labor shortage. There's only wages that are too low.
Right.
It should be very, very straightforward that if you want to attract more and better workers, don't sit there with the same low wage and scratch your head as to why people aren't lining up to take those jobs. Maybe you need to just pay more and not argue for more visas or other things.
It would suggest that there's something that isn't working in the labor market, that there's an imbalance of power in the labor market, which causes wages to be not to be stagnant while there is so much wealth in the economy.
I think we have to say that when we're at a place where real wages for the bottom, probably 70% of American workers have been stagnant for 20 or 30 years, that there's something broken there, and that wages are so low that it is actually dysfunctional. And people talked about, I think maybe Senator Kramer raised it earlier, that there's a low participation rate in the economy. I think raising wages and empowering workers to form unions and protecting labor standards and making sure that labor relations are fair would actually draw people into the labor force, because wages might be so low and jobs so bad that it is rational for people not to come to work if they can't pay for transportation and childcare and other things.
Yeah, thank you. Would anybody, I have another couple of minutes, would anybody else on the panel like to respond to this issue? Now, Mr. Miller.
I would like to, because I think those of us in the quick service franchise world are kind of stuck in the middle on this. And that's because, yes, we see a real shortage of workers. And then you ask the question, well, why don't we pay more? And we're in a margin squeeze right now. Our whole industry is in a margin squeeze, yet you see many of our franchise companies reporting record earnings per share, while the local franchise owner is working harder and longer for less money than ever.
So who's squeezing the margin, Mr. Miller?
Well, between national promotions many times, I mean, I'm in California, so obviously we're not the cheapest labor market in the world. Consumers, are overbuilding of our industry. We have too many restaurants. I mean, the pace of restaurants being built outpaces population growth. Therefore, it's simple economics. I'm just a sandwich guy. I can figure these economics out, and that the pie's getting cut too tight. But, the franchise company makes more and more. If you build 10 units, instead of 8 units, they get it on top line revenue. We're getting it on bottom line
Someone's
profit.
making the money.
Yes.
Right.
So, I mean, that's we're, like I say, pay more, but our business model isn't allowing us to pay more at this point.
Thank you, Mr. Chair.
Thank you, because I do want to follow up on that conversation, because this is the reason why I am introducing legislation later this month to ensure that prospective franchise owners receive accurate revenue and default information from the franchise corporation before they receive a guaranteed loan from the Small Business Association. But let's elaborate on this, Mr. Miller, because what I hear from our Nevada franchisees is that, give you an example, some franchise owners I've heard from tell me they are forced to sell products that they and their customers don't want, that they're charged fees for services that are not valuable to them, and they stay open longer than is profitable and only buy products and services from approved and overpriced vendors. And I'm assuming that's because that's what they are told to do or dictated to by the terms of the contract with the franchisor. Is that correct?
That's correct.
And that goes to why you just talked about your margins.
The margins, and I'll give an example because it was blatantly obvious to everyone. Quiznos, grew to about 5,000 units. It's now a little under 400 units. And the interesting part is it wasn't that they were a consumer failure. The business model failed. Quiznos took on additional debt, the corporation, to try to expand. They also owned the distribution channel. And what was happening was, as they started getting cash flow tight, they would increase the margins on the distribution model. When they filed bankruptcy, they were actually collecting almost double the amount of revenue off of their distribution channel as they were off of royalties. They were collecting 7% royalties, so 21%. There's no way they can make it in our industry. So there's ways, and when we go to disclosure, one of the big problems with disclosure is only valid the day you get that disclosure. So if you went to go buy a Quiznos and you would see maybe, they were, people talk about rebates or kickbacks in our industry, and they have to be reported, but let's say for the last 20 years, a brand took 1% rebate from the vendors and then use that for advertising. Full transparency, I wouldn't mind that. That's what's in the disclosure document. You buy that franchise, and what happens if next year they take 10% rebates? Because the contract says they can take rebates, doesn't cap it. And so here you have this disclosure that for 20 years they've taken 1%. If they raise it to 10%, that completely changes your business model.
Thank you. And thank you for this. Ms. Lee, did you have a comment?
Just a quick point that I wanted to reinforce what Mr. Miller is saying, that one of the things that we're seeing, and I think we've talked about in a couple of different areas today, is a risk shift from employers to workers or to franchisees. And so in your testimony, Mr. Miller, you talked about a lot of the ways in which there's only an upside for the franchise companies. And yet for the franchisees, the little guys, there is so many risks and so many unfair conditions put on them. But some of the same kinds of things we see in terms of the battle in California over Uber drivers, where the company has all the upside and the workers take on the risk. They take on the risk, they take on the expenses of gas and upkeep and repairs on their cars, but also the risk of, not enough business, and the company can't lose from that model. They have all these folks that are just like circulating around, driving and wasting their time. And so the shift from being an employer to having a bunch of independent contractors who own their own equipment and take on all the risk of that is one of those things that I think has systematically undermined worker power in the economy.
Thank you. And thank you to all the panelists. This was a great conversation today. Thank you.